Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day, and we are bringing the VRIC to you, as always, with our series of online expert panels. And today is one that has been a while in the making, and I am very excited. It has finally come together. I'm joined by David Hay of the Haymaker newsletter and co-chief investment officer of Evergreen Gavical, and Louis Vincent-Gave, the co-founder of Gavical, to discuss the state of the economy, deglobalization, and where they're currently seeing value in the market. Gentlemen, it is an honor to have you both on the show.
Thank you, Jesse. Pleasure to be here.
Thank you very much. I'm delighted to be here.
Well, I want to get started with a quote from the aforementioned Haymaker newsletter that you write, David. And in it, you wrote, "Financial conditions are now the easiest in almost 2 years. This was prior to the worst of 2022's brutal bear market in both stocks and bonds. Considering how much tightening the Fed has done since then, this is a remarkable development. It speaks to how much financial markets have eased by reducing interest rates and narrowing credit spreads." Can you break down what this means for the broad market and specifically the handful of big name tech stocks that are outperforming everything? And then Louis, I'd like to get your thoughts after that.
Sure, Jesse. I mean, basically that scenario you just described so brilliantly. uh, and actually I really relied quite heavily on Lizanne Saunders from Schwab. She's been on this theme quite a bit. And it's rocket fuel really for the financial assets in general, but I think particularly mega cap tech in specific, because as you said, it's not just a decline in interest rates. And to put that in perspective, in late October, the 10-year Treasury was over 5%, and it got down around 380, 385 here recently. Now, of course, it's had a major reversal this week that we'll probably talk about, but that's a huge decline in yields in a short period of time. That's obviously beneficial. But even perhaps more so has been the narrowing of credit spreads. And a lot of people don't know what credit spreads are, but they're the difference between what corporate bonds yield and what treasuries yield. And so, for example, one of the reasons why the global financial crisis was as much of a crisis as it was that credit spreads absolutely went bonkers back in 2008, early 2009. That's when high yield bonds were yielding over 20%. And we started to get a whiff of that, frankly, during COVID, where corporate bonds fell out of bed, yields went spiking up, and the Fed did what I had long been saying, and many people laughed at me and said it's impossible, it's illegal. They intervened and they actually started directly buying corporate bonds, which had the immediate effect of bringing spreads down drastically. And that's what really set off the big bull market in April of 2020, when the lockdowns were actually getting more intense and economic activity was getting worse. And yet that's when the bull market started. So it just shows you the power of credit spreads. So those spreads have come down significantly since October. They've come down about 300 basis points if you go back to look at the peak of spreads, which was the summer of 2022. So all that stuff is just turbocharging this market rally we've had. And why does it benefit these mega cap tech stocks? Well, generally, the most, I should say, that they are the biggest beneficiaries. And that's because they tend to have the highest multiples, the highest PEs. So they are the ultimate in long duration assets. So they're kind of like the equity market equivalent of zero coupon bonds. So as you know, when interest rates come down, zero coupon bonds have the best returns because they are the longest effective maturities, because they have no cash flow until maturity. So I'm really talking about long-term zero coupon bonds in that case. So that's why these guys react so favorably to declining interest rates and even narrowing credit spreads. But I know Louis got some very strong opinions about that cohort, so I'll be quiet and let him chime in.
Well, thanks, Dave. Thanks, Jesse, for having us on. Look, I think there's no doubt we see the effects of the easing liquidity conditions in the market. For me, the question is whether we're top of another change. And here, let me perhaps go back just a few months. I think if you go back to October, you had in October, bond yields on the long end of the U.S. Treasury curve that kept going up. You had a stock market that was insanely concentrated. Up until November 12th, the equal weighted S&P 500 was actually down for the year. Late October, it looked like regional banks were going to take out their Silicon Valley bankers. So if you go back to late October, which really isn't that long ago, right? It's 3 months ago. Things were looking pretty dicey. It looked like we were skating on pretty thin ice. And then what did the Fed do? The Fed, I think, having had witnessed the failure of a treasury auction, having witnessed bond yields that kept shooting up, having witnessed, sitting on top of an important change of narrative regarding the U.S. Treasuries, people starting to talk about long-term yields being at 5.5, 6, people starting to talk about term premium on bonds and whatever else. The Fed basically slashed rates on the BTFP programs that they put in place following the Silicon Valley Bank bust. So in essence, what the Fed did is it told all the U.S. commercial banks, here's a free arbitrage. You can borrow money from us and immediately turn around and buy 12-month U.S. Treasuries and capture 75 basis points of spread for free. Now, as it turns out, banks really like making free money. And so bank shares rallied like crazy. November, December, bank shares rallied. Liquidity came out of nowhere to buy U.S. Treasuries. Well, it didn't come out of nowhere. It was given to the Fed, to the commercial banks to do this. And all of a sudden, the broader market rallied. And yes, to David's point, spreads tightened. It was happy days all over again. The Fed wasn't going out to buy U.S. Treasuries directly, but it was giving money to the commercial banks to do it. Now, a couple of weeks ago, this was supposed to last until March. But a couple of weeks ago, I think the Fed decided, you know what? Enough is enough. Let's pull the plug on this. And they probably decided this because actually the U.S. economy is humming along. We saw the strong job growth number. We saw the revised upwards of the Atlanta Fed now GDP. We saw, yesterday's ISM numbers, again, very high. So the Fed pulled the plug on this excess liquidity. And lo and behold, here we are, basically back to where we were before with, as soon as the Fed's free money ends, what do you see? You see bond yields rise up. They've gone up like 30 basis points over the past 3-4 days. You see the market narrow once again dramatically to just a handful of names. Although before, it was people were talking about the Mac 7. Now we're really down to the Mac 3. You only have Meta, Nvidia, and Microsoft making new all-time highs. The others aren't. And so, I think you had a big liquidity injection. And to your point and to Dave's quote, you had 3 months where very easy liquidity conditions. And I think things are changing as we speak.
So, David, before we hit record today, you sent over a chart showing household net worth in the United States. You had a few words to say about that. So tell us about the chart and how you interpret that data.
Well, let me say I'm dubious that it's accurate, but I've seen this from other sources. I've also seen other data that is not as extreme, but there's no doubt that U.S. household net worth has increased since the pandemic. This image that you have shows it going from roughly 100 trillion prior to the pandemic to about 145 trillion today, which is, there's a lot of negativity out there about the state of the United States for, a lot of good reasons, and particularly our finances. It's what I call the federal fiscal funding fiasco, the 4F scenario. But if this is really accurate, you say, well, yeah, sure, government debt's gone up, maybe $10 trillion, $8 trillion, whatever the exact number is since the pandemic. But if households are $45 trillion wealthier, no problem. It's almost like the Japanese situation where, lots and lots of debt, way more than the United States, but it's all owned internally, and Japanese consumers and corporations are very cash heavy and asset rich. And so, maybe it doesn't matter. I think that the more important implication of this, because I'm going to put some words in Louis' mouth just because we've talked about this in the past, that we both believe that countries like Japan and the United States, because they are so wealthy and we're aging societies, particularly Japan, but even the US, we need to have some kind of an effective estate tax in place to capture some of these assets that have been created by these extremely lax fiscal and monetary policies to pay down our national debt, to avoid the Neil Howe fourth turning is here apocalypse. And so that's very, this is a hopeful thing if it's accurate. Now, I look at, the stock market's obviously up. Home prices are obviously up if you can sell them at these prices, which is another story altogether. But my gosh, we got an absolute debacle in office. We've had, I don't know how many trillions lost in things like a lot of cryptos, not Bitcoin, but almost everything else that revolves around Bitcoin, the NFTs and the SPAC. There's been a lot of wealth destruction. The profitless tech stocks that went down 80, 90% have only come back part way. That's why I question this. But if it's true, it's really good news. And so I guess I really haven't put Lou in the spot on this before to ask him, I mean, do you think these numbers are at least in the ballpark?
No, look, I think they are in the ballpark. They're on the other. You've had a massive wealth transfer from government balance sheet to consumer balance sheets, through direct payments, through lots of different things. Having said all this, and to go back to the quandary you posed, Dave, I think, when you look at the growth of assets, the growth of financial markets, I think, most people assume that we're going to see growth in assets of 7, 8, 9, 10% a year, because that's what we've seen, in recent years. And the question is this: how can we have assets grow, let's say 8% a year? And by the way, this is what today, every private credit fund, every private equity fund goes around to see every pension fund around the world and say, hey, we can give you 15% a year with very low volatility, et cetera. So with 8%, I'm actually being quite conservative. But how can we have assets grow 8% in a global GDP that's growing by roughly 3% nominally? Over time, that compounding doesn't work. Now, if it continues down this path, what you end up with is serious political problems, where you have people who own assets and people who don't. And in a world in which, whether you own assets or you don't, you still get the same number of votes, one each. At some point, you will see the people who don't have assets vote themselves some assets. And if and when that happens, your 8% just gets blown out of the water. Your plus 8% a year moves to minus something. So the compounding effects that people take for granted simply do not work. And I'll add one more thing in that, one more quandary today that also makes no sense, is if you look at the US equity market, 20 years ago, 20 years ago, in 2004, the US equity market was 45% of global equity markets. Today, US equity markets are 70% of global equity markets. Now, the US is a little over 4% of the global population, and it's a little under 18% of global GDP. So how can 18% of global GDP account for 70% of the profits? Because if you've got 70% of the market cap in the US, you basically assume that 70% of the profitability is going to flow into the US, and that it's going to keep growing at the same pace. Now, if it keeps growing at the same pace, within the next 10 years, the US is 100% of global market cap. And another 10 years, it'll be 120% of global market cap, which seems to me a sort of high hurdle to clear. And now I know Chinese stocks are terrible, and I know Europe is terrible, but I don't think they're going to have negative market caps. I think they have a firm base at 0, at the very least. So, you look at these maths, and all of these maths that people assume are going to keep compounding at the rate they've been compounding can't. It can't, and mathematically cannot. You cannot have assets that keep compounding at 8% a year when your economy is growing at 3%, and you can't have the US be 70% of global market caps with 18% of global GDP. This is the same story. In 1989, Japan was 45% of global market cap, and it was 12% of global GDP. I think when your market reaches 4 times your weight in global GDP, I think that starts to be a little punchy.
Well, I wanted to turn to the theme.
Statistics.
Go ahead, David. Yeah.
Well, I just want to chime because Lou's also used these statistics in the past that are related to what he just said. I believe, and correct me if I'm wrong about this, Louis, that the U.S. is also 40% of global government deficits and 60% of global trade deficits. Did I get those numbers roughly correct?
You did, yeah.
So that's also, I'd say, completely unsustainable. Louis just said something, he says, makes no sense. I think that's really, kind of should be one of the overarching themes of this entire environment that we're in. It's just, there's so many things that are bizarre and illogical and just don't add up. And we could do multiple podcasts on that theme.
Absolutely. I do want to shift to deglobalization here because this is a buzzword that's getting thrown around a lot. A lot of people saying the world is deglobalizing. Louis, you have an interesting take. In an article you published in December called The Revenge of the Ottoman Empire, you wrote, "Today, the notion that the world is deglobalizing would seem laughable to anyone living in Dubai, Singapore, Sao Paulo, or Mumbai. Rather, the world is going through a new wave of globalization, which is different from its predecessors." So talk to us about this new wave of globalization and how you see it playing out.
Yeah, look, I think, to be honest, when you look at the history of globalization, which really kicks off, let's say, with Columbus, taking off for the Americas, the history of globalization has been fundamentally a Western affair. It's been Western capital, Western logistics, Western infrastructure spending, mostly to bring commodities or consumer goods back into the Western world. And that was the pace. That was the pace of globalization. The reality today, I think, is following a number of things, but most specifically the kicking off of Russia off the dollar system following their invasion of Ukraine, but also the U.S. decision to try to de-Sinify, to kick China out of global supply chains, have triggered two events. The first is that most emerging markets, whether you're Indonesia, Brazil, China, etc., can now buy the commodities they need for their growth in currencies other than the US dollar. And that is a game changer. If you're Brazil, you buy your fertilizer from Russia in reais. If you're China, you buy your coal, your natural gas, your oil. If you're Indonesia, same story, all from Russia, all in your local currency. And this is a game changer because if you're a country like India, you conceptually have unlimited needs for commodities. You have to build roads, airports, railways, buildings, you name it, India needs to build it. The constraint for India is not labor. They've got as many workers as they want. Same story for Indonesia, same story for Brazil, etc. The constraint has always been, how do I get my hands on US dollars to pay for the copper, to pay for the iron ore, to pay for the oil that I need to do all this? Now, if Russia comes in and says, hey, don't worry about that, I'll sell you oil at a 30% discount on a 5-year forward, and you can pay me in Indian rupees, or you can pay me in Indonesia. You've just removed the single biggest constraint to growth with these guys. And so Russia to India trade has literally gone up 8 times in the past 2 years. Just explodes higher. Now, at the same time, what you're seeing is that China has dramatically shifted its production. China's trade surplus in the past 5 years, pre-COVID today, has almost tripled. It's up 2.5 times. Now, the reason China's trade surplus has tripled isn't that you are buying twice as many plastic toys for your kids or twice as many pairs of sneakers. The reason China's trade surplus has more than doubled, almost tripled, is that all of a sudden China is exporting cars, earth-moving equipment, telecom switches, solar panels. And it's exporting most of these things to the likes of India, Indonesia, Brazil, Mexico, Chile, Colombia, you name it. So today, again, you're Colombia. You've got Russia coming in saying, hey, we'll sell you commodities in your currency. And you've got China coming in and saying, hey, we'll sell you the capital goods you need for you to grow, and we'll sell them to you on credit, maybe partly in your own currency if you and I get along. If we don't get along, I'll sell them to you in renminbi, and you can pay me back later. So you can basically industrialize on the cheap, and you can industrialize on credit. And so for all the talk about deglobalization, what you're witnessing is that trade growth is still expanding, and it's expanding because of emerging market to emerging market trade. And so for the first time in 500 years, we have a wave of globalization in which the Western world is not providing the financing, not providing the logistics, not providing the capital goods, and in which the end trade isn't going to to the developed markets, but is staying within emerging markets. And perhaps even most important, the proceeds of these trades are no longer being recycled into Western assets. It used to be that if you were Chinese and you made money, trading, selling stuff to the US or France or wherever, you took that money and you bought a house in Vancouver, or you bought a house in London, or you bought a winery in Bordeaux. And if you were Saudi, and you sold oil, you took that money and you bought a soccer club in the UK, or you bought an office building in Paris. Now, all of a sudden, these countries no longer feel that comfortable doing that. They no longer feel that comfortable doing that because we seized all of Russia's assets with absolutely no legal basis. We just said, hey, you're a rich Russian, ergo, we think you're a bad guy, ergo, we're taking all your stuff. No court orders, no discussion in parliaments, just an executive deciding, I don't like the Russians, so I'm taking your stuff. Now, if you're an emerging market investor, you look at this and you think, well, the only reason I was buying assets, real estate in Vancouver, London, wherever, is I thought it was safer than in my own country. But if for geopolitical reasons I can lose this overnight, then these assets are actually not what I thought they were. And so, for a whole host of reasons, we are now seeing emerging market savings be redeployed in emerging markets themselves. And for me, the biggest story nobody's talking about is the massive outperformance of emerging market bonds over the past couple of years. You look at the outperformance of Brazilian bonds, Mexican bonds, Chinese bonds, Indian bonds over US treasuries, over German bonds. And I'm not talking outperformance of 5-6%. I'm talking outperformance of 20, 30, 40%, which again has occurred in the midst of a Fed tightening cycle. This is what's mind-blowing to me. Having been doing emerging markets for 30 years, I've been used to the fact that whenever the Fed tightens, emerging markets blow up. I mean, that's just what they do. This time, we've had a pretty aggressive Fed tightening cycle. And not only have emerging markets not blown up, they've massively outperformed on the bond side. And some have outperformed on the equity side either, whether your Brazils, your Mexicos, your Turkey. I mean, Turkey, the basket case of all basket cases, is actually outperforming the US in US dollar terms. So I think there's something really important going on there. And yes, I think, Westerners look at their own belly buttons and say, oh, we're deglobalizing, and forget that there's 80% of the world that is integrating at an ever increasing pace.
And David, your thoughts?
Deglobalizing is as much as a reglobalizing. It's a realignment of the globalization process. Yeah, Louis brought up, in fact, I made a note, I was going to say that I thought there was a real definite implication to this kind of gradual investment implication to this gradual de-dollarization that he's describing. Because a lot of people are worried about the dollar losing its reserve status, and it's like it's a binary overnight thing, and that's never been realistic. But this kind of gradual process around the edges that Louis is describing that can gain momentum, fairly quickly is I think absolutely right. And it is amazing to me how little exposure Western investors have to emerging market debt. I think, as Louis said, that they're completely oblivious to how well it's been doing lately. And what's interesting is a lot of these emerging market bond markets still look very attractive. I mean, look at Brazil, and Louis probably knows the numbers more precisely than I do, but I believe the 10-year Brazilian treasury, in effect, is at still 10 in reals. And inflation is running about 5, so you're getting about a 5% real rate. Is that fairly accurate, Louis?
Yeah. Oh, look, you can buy 5-year tips in Brazil, giving you 5.5% real. And yeah, it's like, well, I look a gift horse in the mouth as far as I'm concerned. 5.5 to 6% real is as good as you're going to get in most asset classes.
Yeah, so I think even though these bonds have done very well in recent years, I think there's a lot further to go, at least in the stronger markets. I think they're, unlike with Turkey in the equity market, I think the Turkish bond market's been a disaster, right? At least in dollars. So you have to be careful which markets you're going into. Some of the emerging markets are, still submerging. But I think the other implication is to U.S. Treasuries from what you were just describing, because in the past there was this constant bid in the U.S. Treasury market from these overseas central banks that would accumulate dollars from our chronic trade deficits and plow them back into treasuries. And if they're not doing that anymore, that's a big game changer, especially given these enormous deficits that the federal government's got to finance. at a time when banks are selling treasuries. The Fed is even selling treasuries. And, that's why I worry that this year, not some indefinite year in the future, but this year, 2024, we could have a real seizure in the bond market. We got a little bit of a sneak preview of that last third quarter, as Louis was mentioning. But that the belief is, the peak is in, we're not going to see anything like that, but that could be wrong. We could have another severe test with higher treasury rates, at least at the long end, just because there's so much supply and dwindling demand. But maybe that's something Louis might want to address, because I think that's a hugely important point.
Well, look, I think we're heading into a year where between the rollover, so the U.S. government's going to have to roll over this year around 8 trillion, and it's going to issue another roughly 2 trillion additional bonds. So, you're going to have 10 trillion of new issues hitting the market this year, which it's never happened before. Now it's these things, bond issues and leverage. It's a little bit like tequila shots, right? You never know when you've had enough until you've had too much. So we're heading for a 10 trillion year. Is that too much? It sounds like a big number to me. I think we'll see. It might be one tequila shot too many, but and if so, the bond market will find itself, heaving in the bathroom. Now and that's not a pretty sight. So yeah, I don't think you want to be part of it. And to your point, I think a lot of today, if you're a foreigner, and we know the Swiss National Bank is doing this, but I'm thinking others are doing the same. If you're a foreigner and you're like, okay, I have too many US dollars because the US trade deficit is massive. What do I do with these dollars? Do I buy US treasuries whose supply keep going up every year? And which really have done very little for me for the past 3 years now, and which have not, even diversified my other positions, etc. And remember, now I need fewer dollars. If I'm China, increasingly I'm buying more and more in my oil in my own currency, both from Iran and from Russia. So I now need fewer dollars than I used to in the past. So what do I do with these excess dollars? Well, perhaps I just go out and buy the top 20 market caps in the world, which is what the Swiss National Bank has been doing. And I'm guessing others are doing the same. And frankly, it makes more sense. Just, I have a chart in my chart deck which shows the supply of US treasuries. And, it looks like a rocket taking off. And you look at the supply of Microsoft shares. And every year, Microsoft buy back stocks. So on a 10-year view, what makes more sense? Owning US treasuries or owning Microsoft? On a 10-year view, regardless of the valuation of Microsoft. On a 10-year view, what makes more sense? Owning French 10-year OATs or owning L'Oréal or LVMH? I think on a 10-year view, when I look at how much money is being printed, etc., I'd rather own L'Oréal, LVMH, and Microsoft. Even though all these stocks are expensive, I'd rather own that than bonds, because I know that in an inflationary environment, over the very long term, stocks actually are always worth something. That was the big lesson of Zimbabwe, of Hungary, of Argentina, of
Weimar Germany.
Weimar Germany, is that bonds in a really high inflation environment, bonds are actually a zero. They basically become worthless. Equities initially go down, but they find a floor at which they're still worth something because you have a business that produces cash flow.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Well, I would like to then get your thoughts on where you're currently seeing value in the market based on everything we've discussed, all the trends, all the developments. Obviously, emerging market debt is something that you've mentioned already. Are there any other areas that you think people should be looking at for the average retail investor out there who maybe wants to take advantage of these current geopolitical factors, trends, et cetera? obviously we don't offer investment advice here, but what areas are you both personally seeing value in at the moment? And Louis, I'll start with you.
Darn, I was hoping you'd start with Dave. Yeah. Okay. So first things first, the way I look at, when I build my portfolio, I look at it like putting together a football team. Where you have different assets that do different things. I wouldn't expect my offensive lineman to run the 100 meters in 10 seconds. And I wouldn't expect my quarterback to be tackling everybody. So every asset needs to do different things, which is why I'm always reluctant when they say, okay, where do you think you put your money? Well, it's like, who'd you pick for your football team? Different positions require different things. Now, the first, when you put a football team together, the first job is you put your offensive line. For me, the offensive line is your anti-fragile assets. It's, assets that are going to protect everything else when things go badly. And this is the first massive challenge today, is that, for all of Dave's career, all of my career, all of your career, the anti-fragile asset of choice was U.S. Treasuries. It just, whenever equities went down, U.S. Treasuries stepped up to the plate, delivered positive returns, etc. They've stopped doing their job for the past 3 years. For me, the U.S. Treasuries are an offensive lineman that's now 50 years old. It's got broken knees. It can't move anymore. It's just become useless. So the first big challenge for me when you put your portfolio together is what anti-fragile assets do I buy? And the big problem is nothing is as good as U.S. Treasuries. Like U.S. Treasuries was, and I'm mixing my sporting analogies here, but it was the Michael Jordan. It was of sports. It was like the greatest athletes of all time. And so how do you replace Michael Jordan? The reality is you can't. You can find something that's almost quite as good. And I think emerging market debt is some of that, a little bit of gold. To be honest, I would say low volatility energy plays, because the real risk to our system today is higher and higher inflation, which would come through higher energy. So things like MLPs that have done very well for the past few years, basically all your midstream guys, you put all this together and it almost gives you an anti-fragile asset. So I would still, start with that. Now, from there, after that, where do I find income? Where do I find defensives? Where do I find growth? I think the growth story is obviously the most important one. For me, there's two choices as you look at the markets today. When you look at the markets are telling you two things. They're telling you the next big growth story is AI, it's quantum computing, it's electric vehicles, you name it, it's semiconductors. And the valuation for this is extremely stretched and it's extremely crowded. The markets are also telling you there's another story on it. And that story is consumption and infrastructure spending across emerging markets. And you're seeing this in the performance of the Brazil stock market, the India stock market, the Indonesia stock market, the Turkish stock market, the Mexican stock market, all of which have actually outperformed the US stock market over the past couple of years without being extremely narrow. And that's my big problem with the US stock market is how narrow it is. You look at the Mexican stock market, or frankly, the Japanese stock market, and it's extremely broad. Everything's going up. So I feel much more comfortable saying, okay, maybe the next big story is EM consumer, EM infrastructure spending, because the market, the momentum is there as well, but the valuation's on a stretch, and it's definitely not as crowded. So for me, the opportunities are in Mexican stocks, in Turkish stocks, Indonesia. Now, there's a lot of ways to play that EM consumer and EM infrastructure spending. Just like there was a lot of ways to play the China boom. You had a huge boom in China from 2000 to 2012. And you could play it, of course, owning Chinese real estate or owning Chinese banks. That was one way to play it. But there were other ways. You could play it owning French luxury goods maker. You could play it owning commodity producers. You could play it owning Caterpillar. There were lots of ways. Now today, it's an Caterpillar is back to all-time. And it's I think for a number of reasons, not least of which the U.S. inflation, the well-named U.S. Inflation Reduction Act. As I look at this EM boom, there's ways to play it. For me, one of the ways to play it is Japan. Lots of Japanese companies very plugged into what's happening all across Southeast Asia, all across the Middle East. and the yen is just crazy cheap. I love buying undervalued assets and undervalued currencies. You know, I feel like I'm not going to break a leg falling off the first floor window. And so I like Japan a lot. Now I also tend to think that, you know, babies are being thrown out with the bathwater in China. There's lots of Chinese companies that are going to be participating in this emerging market boom. You know, take Alibaba as an example. Most people look at Alibaba as a Chinese e-commerce platform. The reality is it's increasingly a pan-emerging market e-commerce platform. Alibaba is huge in Indonesia and Vietnam, across Latin America. So lots of different ways to skin the cat. For me, the trend is you're going to have an EM consumer and infrastructure spending boom. Find smart ways to play it, and there's lots of them.
Excellent. And David, yourself.
Well, just kind of going with Louis' matrix there and kind of populating the defensive part of the portfolio first, which is, I think, always a good idea. Fortunately, there's a lot of options, which was not the case a couple of years ago. I mean, interest rates went missing. And in fact, Jim Grant, Grant's interest rates observers had a great quote the other day. He said, it's certainly nice to have interest rates to observe again. And that's very true. And so it seems really simplistic, but the idea that you can get, roughly 5% with short-term treasury bills, I think is an appropriate part of anybody's portfolio. I'm much more confident with the short end than the long end of the treasury market. But I think to get, obviously, if we're peaking in interest rates globally, which I think is somewhat controversial, but it could be happening, then I think that's where you really look at some of these closed-end funds. So your listeners can easily buy these. It's not as esoteric as it sounds. So there's a number of closed-end emerging market debt funds. Louis is actually rolling out an interesting one that's going to really target Latin America, South America, which there aren't very many funds that do that. In fact, that may be the only one. So the other ones are a little broader, but there's some attractive Asian bond markets as well with not low yields, but some pretty healthy yields like Indonesia. So that's an attractive area, I think, for defensive. Louis mentioned midstream, and there's names like specifically Western Resources that looks pretty good with about an 8% yield. One of our favorites is actually MPLX, which is the midstream for Marathon Petroleum. That yields 9, sells at only 9 times earnings. And it's also breaking out to a new high. So that's probably a good segue into the more offensive part of the portfolio and what I like to do, because I think there's a danger if you're really kind of a hardcore value investor and you're loaded up with these things that are out of favor and they look really cheap and they might do great over a 3 or 5 year period, but you lag so severely during that period until they finally come back into favor. So I think it's appropriate and almost essential to have a barbell type of approach where your equity portfolio is going to mixture of names that have momentum. And obviously you can go with tech and get momentum, but I think the trick is to find momentum plays that still have some reasonable valuations and they're not too extended. And that, I think if you look at a chart of MPLX, that's a good example of one that's got momentum, but it's definitely not too extended. I think Chubb's another interesting name in that regard, the big insurer, which is broken out and yet still trades very modestly. And as maybe you've been reading, insurance premiums are just absolutely going nuts. So that's another reason why I question this, low inflation that we're supposedly going to have dominating for the next few years. So I think mixing these things and then, looking at some of the really out of favor areas where you could get lucky and they could come alive sooner rather than later. And it's hard to find anything that's more out of favor than the gold miners. So it's really ironic that gold is, holding over 2,000. A lot of people are frustrated that it's not having that big breakout. But I mean, given where real interest rates are and how much rates have gone up, I think it's pretty commendable. Gold has been hanging in there a little bit over 2,000. These miners should be doing really well with gold there. And, personally, I've written on this and talked about this. They're not as well run as, say, the big energy companies, because gold is higher than it was 11 or 12 years ago, whereas oil prices are quite a bit lower than they were. And yet the oil companies are making record profits and the gold miners aren't. They're not making anywhere near what they made, back in 2011, 2012. But they are so cheap and so hated. And if gold does bust out to the upside, which I think is inevitable, and one of the reasons I think that's inevitable, and I think Louis would agree with this, is that we're going to get a recession at some point. I don't know when it is. I thought it would be sooner rather than later. I did my own pivot back in December because of what Powell in 2 weeks or 12 days made such a change of, we're not even thinking about lowering interest rates, and now we're talking about 3 cuts. And that was pretty instantaneous, and maybe that was politically motivated. Maybe there multiple reasons behind it, whatever had happened. And then the other kind of epiphany that I had was looking at the federal deficit for this fiscal year, because as you know, Jesse, the federal fiscal year starts in early October. And this one, despite increased government revenues, outlays are running even ahead of that. So we could be looking at a greater deficit than 2 trillion that we had last year, which was already outrageous. So the point is, why I've had kind of this shift on my economic outlook is this combination of these significantly eased financial conditions that we talked about earlier, combined with this just out of control federal spending. It's tough to have a recession with that kind of a backdrop. Now, could it happen? Yeah, it could. I mean, there are some still very powerful forces, and a lot of the leading indicators are screaming recession, but I think they're probably early, just like they have been. Now, at some point, you could make the case that we're really going to get a doozy because it's been delayed. It should have happened earlier, probably would have been less painful. But when it does happen, this is really what I was leading up to, the policy response is likely to be so inflationary, whether it's, hyper QE, and obviously huge cuts in interest rates would be the first thing they do. And I got to believe in that kind of a scenario that these commodities in general, whether it's energy or gold or, some of the agricultural, let's say the fertilizer stocks have been so annihilated, are going to have just epic moves. And if you think it can't happen, go back and look at what happened to the price of GDX, which is the gold miner ETF, the senior gold miner, or GDXJ, which is the junior miner ETF, and how they went absolutely bonkers. The other thing is that I know Louis and I are both really bullish on uranium. Now, it's been a great winter. It's very different than gold. Uranium's over $100. It was, 40, 50 not long ago. It's tricky to find plays in that area. It's not like energy where there's just bargains galore. So I guess, looping back to what I like the best in that area would be energy. Some of these companies like APA, which are trading 5 or 6 times earnings, and have been, they're down like 40% from their peak of 2022. So there's bargains galore in the energy world, but nobody wants to own them, which, that's usually a good sign.
And conversely, on the other side of the coin, are there any sectors that you would completely avoid at the moment that you do not see having a bright future? Obviously, we've talked about the Mag 7, as Louis has said, that's been reduced to the Mag 3. Do you see that as being far too overvalued to dabble in? Obviously the meme stocks, crypto, these are other areas I think a lot of people would say would be best to avoid. But I'm wondering what your thoughts are there. And David, I'll start with you on this one.
Well, I think green energy kind of comes up as one that's highly challenged right now. I think that there is a sea change going on from that being just like everybody said, well, I got to have part of that in my portfolio. My gosh, the long-term trends are so favorable. And I've been very critical of EVs, thinking that they're going to have a lot of consumer resistance at some point. And I think we're now seeing that. And in fact, the headlines have become so pervasive that you almost wonder, as a contrarian, is it time to buy? And I think at the end of December, there was they were really beaten down with tax loss selling. There was a kind of a short-term trade, which we did a little bit of, but I do think that area is really challenged, which then loops back to traditional energy. That was kind of the big negative. With that taken away, or at least mitigated, perhaps that's another reason to be bullish on traditional energy. But other than that, I think companies which have extremely high valuations, maybe NVIDIA is worth it. I think maybe is the key word there. But there's an awful lot of companies. Just look at, grab an Investors Daily and look at the number of companies that you've never even heard of that are trading at 50, 60, 70, 80 times earnings. Or to throw out one it's kind of my constant, I just think this makes absolutely no sense, is WD-40, which just makes that lubricant in the can. And yeah, it rose pretty steadily and it had a positive earnings surprise, but it's 50 times earnings. I mean, come on. There's just a lot of stocks out there that the valuations are just utterly absurd.
I definitely agree with you on the green energy front. I think that whole scenario is not going to unfold as the global elites think it will. And I think that will be massively beneficial for hydrocarbons. Louis, your thoughts on sectors to avoid?
Well, I think, look, let's start off with, what gives things value. And in our research, we talk a lot about jewels versus tools. Things have value either because they're rare, i.e. a really nice house on the peak in Hong Kong, or a diamond or gold, or because they're useful, i.e. they generate cash flows. Now, of course, valuing things on cash flows is a lot easier than valuing things that are rare, right? It's like, what's the value of a gold bar? Um, things that are rare, whether Bitcoin, gold bars, houses on the peak, there's a highly emotional level to it. And it's also linked a lot to, I think, liquidity creation. When there's excess liquidity, a lot of it tends to flow into things that are rare. But where the alarm bells go off for me is when things that were previously valued as as tools, i.e. on their cash flows, start to get valued as jewels. And NVIDIA is a perfect example. It's, okay, this is a great company. It makes great semiconductors. So, we can expect that it's going to make so much cash flows over the coming years. And as it gets more and more valued, people tell you, no, forget that. Forget that. It needs to be valued as a jewel, because what it does is so very unique. It's like what nobody else does. Now, companies that move from being valued as tools to being valued as jewels, it seldom works for the long term, because whatever, somebody else starts producing whatever they're producing. The history of capitalism is just not great in protecting monopolies. You might have a monopoly for a little bit, but eventually either somebody else comes after you, or the governments come after you. Now, today, I would say that you guys mentioned the green stuff, EVs. EVs are particularly at risk, partly because China decided, we're going to be big in EVs. And so China, 5 years ago, decided no more money for real estate. All the money goes to EV. And now you've got overcapacity coming out of your ears. There is so much capacity that every Western government is now thinking, oh my God, if I keep pushing EVs, that means that every car on the road is going to be Chinese, which obviously no government wants to even think about. So now all of a sudden, everybody's going to claw back. Now, guess what aside from EVs, where did the Chinese government decide 5 years ago to push all of its money? Say, okay, we're not doing real estate anymore. We've gone too far. The other place they've decided we're going to push all of our money is semiconductors. Because the US said no more semiconductors for you, China had no choice and still has no choice but to pour money, pour resources, pour human capital into the development of semiconductors. Now, on this, China every year graduates more engineers from its schools than there are engineers in the US. And all these kids are being told, go find the semiconductor solution. Now, on the other side, we've got a Western world that says NVIDIA is awesome, and we should treat it as this rare gem because nobody will ever be able to undermine it. And China is saying, hold my beer, in essence. I'm going to pour money and people at this. Now, you look at historically, the global semiconductor sales. Right now, global semiconductor sales are roughly 50 billion a month, so 600 billion a year. Historically, the valuation of the semiconductor sector was always between 2.5 times annual sales and 5 times sales. Today, we're at 9 times annual sales. So the semiconductor sector today is trading at 9 times annual sales. Now, semiconductor sector, which is one of the most cyclical, most capital-intensive sectors out there, is trading at 9 times sales. At a time when China is saying, I'm going to pour money into this and I'm going to crack the code. So in essence, when you're buying your semiconductors at 9 times sales, you're making the bet that forget what China's doing. They can't crack the codes. These guys are half-wits. They'll never be able to do anything. I think that's a bad historical bet.
Well, gentlemen, this has been a fantastic conversation. It did not disappoint. You both delivered so many gems of wisdom. Truly appreciate it. Before I do let you both go, David, tell us about Haymaker and anywhere else you'd like to direct the audience.
Sure, people can follow us, Haymaker _ at Substack. And while we do have a paid newsletter, a fair amount of our content is free each week. So go check that out, please. And then also
the paid stuff is better. The paid stuff is better. So,
of course,
it's a sign up.
better. It's a steal. And then also Evergreen Gapcow, which is my day job, and that's where I am co-chief investment officer. And you can easily go to our website, but also there's a link from Haymaker to that as well. So it's pretty easy to find either me or the firm.
Great. I'll put links to both in the description below. And Louis, tell us about Gavical. Tell us about your writing, and anywhere you want to direct people online who want to hear more from you.
Yeah, so GavCal is a research firm. We produce a lot of research, macro research, a lot of China-related research, but it's mostly geared towards institutional investors. So if you're an institutional investor and you want to find out more about our writing, please go to gavekal.com, GAVEKAL.com. We also manage some funds for institutions, with mostly in Asia. Again, you can find out more information on our website. Yeah.
Great. I'll put a link to that in the description below as well. Thank you once again to both of you for coming on the channel and sharing all your knowledge.
Thank you, Jesse. Pleasure to talk to you again.